That is the breaking news then this hour. The South African Reserve Bank's Monetary Policy Committee has, by split decision, decided then to keep interest rates unchanged. The repo rate will remain at 3.5%, while the prime lending rate, which is the rate that we lend at banks at, will remain at 7%. The bank not seeing necessarily any hope for a change in that interest rate figure in the short term, and perhaps looking towards inflation expectations being still within the 3 to 6% target range for the medium term at the very least for the bank's ratios, particularly looking at 2021. So let's unpack this now. What does it actually mean for you and I? And were there perhaps other connotations to this that we could have seen come through as well? Isak Oudendal is an investment strategist at Old Mutual and joins us now via video link. Isak, thank you so much for the time. Appreciate it. It was a split decision. Does that shock you at all? Is this now just becoming the norm?
No, it was exactly the same last time. So it does suggest there are two committee members who would prefer to cut interest rates, and I think the majority still think that the current stance is appropriate. I mean, the outcome was as expected. I think if you also read the statement this time and last time, they kind of made it clear that they've done that in the mind of the committee as a whole. They think they've done enough to support the economy with the rate cuts we saw earlier this year.
Yeah, the inflation situation, though, is one that it will remain muted for the longest time, right? Or by the seams of it, at the very least, up until at least the first half of next year. Did that not give enough space? I mean, we've continuously said, or the Reserve Bank has continuously said that they want things anchored towards the midpoint of that target range. But it seems that wasn't enough in the last meeting. It's not enough this time around as well. Why is that?
Yeah, I think that is disappointing. I think if you only went on inflation, as well as the inflation outlook, which is more important for monetary policy, as well as inflation expectations, which, as you said, are quite anchored, then you would cut rates. But I think that's not the only consideration. I think the Reserve Bank is still nervous around the potential for the government's debt situation to result in a market sell-off, a weaker rand at some point down the line, and then that weaker rand could translate into higher inflation. So there's an element here of risk management. They are concerned about the debt situation impacting inflation down the line. So this is not a pure inflation call. It's also a kind of a risk management call.
Do we keep then perhaps seeing interest rates remain at these levels for what could be at least the next 6 months? I mean, that's for what, about 3 meetings into next year?
I would definitely think that interest rates remain at this level, and potentially there is still a bias for a cut. I mean, if we have a situation where the rand continues to appreciate as we've seen in the last few months, oil prices remain low. I mean, then I think the pressure will build for another cut. But certainly, at the very least, you would expect interest rates to remain at these levels for a considerable amount of time. I suppose the trade-off is if you cut now, there is potentially going to be a stronger recovery and therefore an earlier hike. Whereas if you keep rates where they are now, potentially you can keep them flat for longer.
Yeah, it seems, however, though, that we've gotten a slightly better picture when it comes to the growth number. Yes, it is only slight, but we had initially expected 8.2 in terms of the contraction. Now it's 8%. Does that mean that things aren't as bad as we initially expected? Or is that just perhaps some other issues at play, you think?
Yeah, look, at this stage, I think we'll take every bit of good news that we can. But ultimately, the difference between 8.2 and 8 is not much. An 8% contraction is still historically bad, and it is still a massive, massive blow to the economy. And I think for that reason, it's maybe another argument to say perhaps interest rates should have been lower.
Yeah. What do you think we're missing? What is it that we actually need to get not necessarily just interest rates, but a movement either way? Because, of course, lower interest rates don't necessarily help savings. The carry through as well, the carry trade also gets hurt quite significantly as well, and you want to keep that going. So what is it that is perhaps missing on either end of the scale? And tomorrow is, of course, the announcement by the ratings agencies. Do you think that would have any impact?
I don't think the ratings agencies will have a big impact. But I think the underlying issue here is the government's fiscal problem or the debt situation. So if you could get a proper handle on that, if we could get movement with fiscal consolidation, with narrowing the deficit, stabilizing the debt, then a lot of the other dominoes start falling over. So, for instance, then your credit ratings start improving. Then the risk that is priced into the bond market that's keeping those long-term interest rates very elevated, that starts coming down. That should have a positive impact on economic growth. And that also removes the risk factor from the Reserve Bank's point of view, and it will potentially allow them to cut short-term interest rates as well. So that is really the kind of the one thing that is causing problems, across a wide number of fronts, and that if we can get some positive movement there, would actually unlock the potential for lower borrowing costs in the economy.
Could we have done more? Could the Reserve Bank as a whole have done more to support South Africa's economy amidst the COVID-19 pandemic? Or is this perhaps the limit of their powers?
I think they could have done some more. I think they obviously cut interest rates quite sharply. But as we've said now, there's possibly room for minor further reductions. They also intervened in the bond market to introduce liquidity when things were looking quite shaky in March, April. That helped, but I think they could have done more there. If you look at what some other emerging market central banks have done, they intervened quite a bit more in the bond market. And again, it's about getting those longer-term borrowing costs down, because yes, the household borrowing costs come down when you cut the repo rate, but a lot of other actors in the economy borrow long-term in the bond market, and those very high interest rates are still an impediment to growth. So I think they've done a lot. I think they could have, with imagination and boldness, done some more. But they have at least done a substantial amount of easing, in the face of this crisis. I mean, it is ultimately, this is it's the 1 in 1,000-year flood. So it's an unorthodox period. It's an unusual period, and I think it does call for some unorthodox policy.
Yeah. So you don't see perhaps let's call it a second wave of monetary stimulus in any particular way?
Again, it'll depend. I mean, they've said time and time again it's data dependent. So again, if either the economy weakens a lot or inflation comes down, I think there's room for further easing. If you look at what's happening globally, you had a period of stable monetary policy, and now I think just in the last while, the ECB, the Federal Reserve, talking about potential further easing. You've seen the Central Bank of Indonesia cutting rates this week. I mean, Turkey's been the outlier. They've hiked interest rates, but they are a bit of an unusual case at the moment. So you are potentially seeing another wave globally of central banks easing policy, and I think that could also weigh in the next couple of months. Could provide some room for the SARB to cut rates once more, or twice more.
Does an interest rate at this level actually help consumers at all? And I ask that because we keep saying that the carry through to consumers may take some while to actually filter into the system. You have the loan guarantee scheme, which of course is in aid of COVID-19. Plus, you have this element of low interest rates. House costs, house prices are expected to perhaps stay low for a little bit longer, so it may be a buyer's market for the longest time. But, does it help the average consumer really to have interest rates at 3.5% for the repo rate and 7% for the prime lending rate?
It does help if you think of the fact that if you have debt, your monthly repayments would have declined quite a bit. So that obviously frees up a bit of cash. Does it stimulate new borrowing? I don't think so. I think in an environment of very low consumer confidence, people are uncertain about the future. It's probably not going to stimulate a lot of new borrowing. Although, I mean, there's talk in some pockets of the housing market that you are seeing a bit of recovery. But ultimately, I think the bulk of the support for households comes through in the form of lower monthly interest payments on car and home loans. That frees up a bit of cash. The next question is, do households spend that cash or do they save the cash? If they save the cash, obviously there's no impact on the economy. If they go out and spend that money, it circulates and it kind of helps raises economic activity, raises incomes, and so on.
Yeah.
So it also depends how consumers behave given the lower interest rates.
It's very
But
weird though, isn't it? Though, Isaac, we're looking for, I suppose, a time when consumers will perhaps spend more money to boost South Africa's economy, but we keep on saying we're not a saving environment either, unfortunately, and not a savings country. Which of the two perhaps is more significant and more important given the state of our economy right now?
in the short term, I think you need anything possible to boost spending, including interest rate cuts. But what you've seen in the rich countries of the world, they've actually literally sent checks to people to say, go out and spend this money.
Yeah.
That's what you need in the short term. You want money to circulate in the economy. You want more spending. The issue of savings as an enabler for long-term growth that's a long-term issue.
Yeah.
You're not going to solve that. You're not going to solve that by changing the interest rate. That is a much deeper behavior problem. That's not something that the Reserve Bank can tackle with the NPC meeting.
Yeah. Let me be a little more controversial maybe with this question. Hopefully you won't shoot me out here, Isaac. But should we then have had the loan guarantee scheme as it is? Should we have continued to make it a loan for people as opposed to perhaps, as you said, literally giving people checks in order to go out and spending? Was the 350 Rand that we gave out to even the unemployed sufficient? Or should we have even done that with the 200 billion that we had set aside for the loan guarantee scheme?
No, I think clearly that scheme has not delivered quite as expected. But I think the problem is, it again comes back to government's debt level. Because we came into this crisis with a high level of government debt, and therefore we could not respond in the same way as some of these other developed countries have responded. So to put it in simple terms, the government simply did not have the money to inject funds into the economy, into businesses, into households.
Yeah.
Rich countries can borrow at very low interest rates. The US can borrow at less than 1% for the next 10 years. So it makes sense for them to borrow a lot of money and spend that money. It's basically free for them. For us, the government borrows in the region of 9-10% over longer periods of time. So it's a very expensive exercise for them to borrow and spend in the economy. And of course, they came into this crisis with a lot of debt already. And I think that is, once again, that's the big underlying problem here.